Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I've been studying and testing finance strategies, and particularly infinite banking, my entire career in the finance industry. One question that comes up regularly with my clients is, what's the downside? Or is infinite banking something I should do, or should I stay away from it? Well, these are definitely legitimate questions, especially since the strategy is so far from mainstream and so misunderstood by most of the people who even talk about it at all. First, infinite banking, the infinite banking concept, or IBC, is a term coined by Nelson Nash, who wrote a book titled Becoming Your Own Banker, The Infinite Banking Concept back in 1993. The basic idea is to fund a participating whole life policy and then leverage the cash value of the policy with policy loans to finance the things you would otherwise finance with bank loans, including credit cards. Of course, that begs the question, why? The answer is because the cash value of participating whole life grows at a guaranteed interest rate, which is compounding and is at a much higher APR than you can get from any bank accounts. The compounding growth of that cash value is tax-free as long as you don't surrender the policy. And you can take policy loans against the cash value from the insurance provider. Generally, the simple interest rate charged for those policy loans is lower than the compounding dividend interest paid to the cash value. So that provides for a positive arbitrage on the interest paid versus the interest charged. Because any loans made are collateralized by your cash value. You don't have to agree to make any kind of a repayment schedule. The infinite banking concept or strategy as outlined by Nash does make repayment a requirement. But that repayment can be as unstructured as you choose. For instance, I have clients who regularly take large policy loans to finance real estate deals where they turn properties for a profit. It may take up to several months to flip those properties. During those months, they don't make any repayment to the policy loans. They repay the loans from the profits they realize when they sell the property. All those flexibilities are in play no matter what you might use the loans for. Whether the loans are used to buy furniture, take vacations, buy inventory or equipment for a business, or invest in stocks or real estate, what the loans are used for doesn't matter. The only requirement to qualify for a policy loan is that you have at least enough cash value in your policy to cover the loan. There's never any credit check or explanation required of what the loan will be used for. So then the question, why life insurance? Why not a bank savings account? Well, the answer to that is multi-layered. First, if a bank provides a loan, even with a savings account being used as collateral, the bank would get the positive interest rate arbitrage, not you. Second, with a bank loan, you would not dictate the repayment schedule. The bank would. And again, there's no way a bank savings account will pay anything close to what mutual insurance companies pay to their participating whole life policies. And remember, the dividend interest your cash value earns in your whole life policy is tax-free. Not the case with any bank product. A couple additional bonuses with the cash value of whole life are the cash value of life insurance is fully protected against lawsuits, collections, even bankruptcy. That is not the case with any other financial product. And of course, life insurance pays a tax-free death benefit when you die. No other product offers that either. So then, why or even how can infinite banking be a bad idea? There are those who insist that whole life insurance is a bad idea. For example, Dave Ramsey and Susie Orman. But they have ulterior motives. They say the return on investment with whole life is bad and that you should buy term insurance and invest the difference instead. Well, you know, they are investment advisors, and that's how they make their money, by investing other people's money. So that's an ulterior motive. Also, they either don't understand how participating whole life works, or they just lie about it because they can get away with it, and it persuades people to hand over their money to them to invest for them for a price. Others say it's just not a good idea to take policy loans. In my experience, those who say it's not good to take policy loans don't understand the strategy or even how policy loans work. It's true that if you don't have any self-control or self-discipline, you can get yourself into trouble by taking policy loans and not repaying them. It could get to the point where the lack of repayment could cause the policy to lapse. That would not be good. But short of going crazy with taking policy loans and lapsing your policy, the only reason practicing infinite banking is a bad idea is that it pretty much eliminates commercial banks from profiting from your ignorance about the strategy. Poor banks. Basically, the idea that infinite banking is a bad idea is simply negative propaganda promoted by the banking industry and a large number of investment advisors and financial planners. For more on the infinite banking and tax-free cash growth warehouse strategy, watch our free webinar, Become Master of Your Financial World, at the link below. Also, please subscribe to this channel and check out the answers to frequently asked questions and examples of application of the strategy. And please post your questions and comments here. For now, aloha and mahalo for watching.